Welcome, my name is Sasha Moore and I'm here today with Andrew McVeigh, who is the Managing Partner of the investment management business Ramara. Welcome.
Thank you, Sasha.
So Andrew, I'd love to get your opinion today about the vertical integration model and why that's powerful and why you've chosen that model for Ramara.
Certainly. It is a unique model in the market, particularly with the private credit offer, or within the private credit offering. The reason why we've chosen it is we think it gives us a substantial benefit in terms of managing the risk profile, managing the credit assets that we generate on a day-to-day basis based on industry trends, credit trends, liquidity trends, and distress we ultimately see. In addition to that, it also gives us a very diverse range of credit that we can write. So ultimately, the vertical integration model means that we've got ownership stakes within each of the originating businesses that feed up into the fund investments. And while a lot of people will look at that and go, well, hang on, isn't that a conflict? It could be. However, we actually use independent trustees, we have third-party fees and returns that are all set, we've got pool parameters and eligibility criteria that are set by third-party investors. So we're not setting terms and conditions for businesses that we essentially own, but what we are doing is we're essentially investing into the first loss notes of those originating businesses. So what that means is if there are losses in the pools, we wear those losses before any fund investor wears those losses. So there's a complete and utter alignment of interest. But as I mentioned before, it gives us the ability to manage the overall pool based on what we need to manage for investors. So if investors are looking for liquidity, we can actually write more short-dated loans that have a 3 or 4 month weighted average life, and that means that we're turning money over on a faster basis and we can offer more liquidity to investors if they want to come into the fund or exit the fund. It also means that we can actually mix and match our loan book to get that right mix of liquidity, yield, and diversification. So because we can write across a lot of SME loans, business loans, trade finance, invoice finance, and mix that with real estate loans, we've actually got a very unique proposition, and we do a lot of the portfolio management that you would need to do yourself as an investor by saying, I want one manager who manages real estate, one manager who manages business loans, one manager who manages consumer credit, those types of things. We essentially do all of that. But that vertical integration model means that we've got ownership stakes across each of those originators. So we're managing in a uniform way the credit, the servicing, the underwriting, and the whole package as to how these loans are originated, how they're managed, and essentially how they're serviced. So from that perspective, it gives us the ultimate control over adjusting the portfolio based on what we're seeing in the market. And we believe it actually gives us the ability to reduce the overall risk profile for end investors while still giving them the same return profile.
Okay, fantastic. And in terms of the market appetite for this type of model, what are you finding that to be at the moment?
Look, I think it's a unique model and not a lot of people have come across it. And I think once we're able to explain it and people understand the benefits of that integrated model, there's definite synergies that investors ultimately receive. The feedback to this point has been the first loss alignment is very strong because essentially, again, we're making credit decisions on a daily basis that will feed up into the fund, but we lose our money first if those credit decisions are the wrong decisions. So that alignment of interest is unique for most private credit managers, and investors love that. They like the ability for us to be able to manage the portfolio and create the right composition based on the investor pool that we've got, and also be able to create the enhanced yield that you get through more illiquid construction style loans, but also the short-dated kind of velocity and high turnover of cash that you can get on short-dated things like insurance premium finance or trade finance, where you can actually manage the pool to ensure that you can pay distributions out to investors, you can pay redemptions out on a quarterly basis, but you're also then having a pool of loans that actually provide you an enhanced yield on the basis that the underlying loans are not liquid.
Okay, great. Thanks for your time today.
Thank you, Sasha.